So, what are price earnings ratios all about? You hear them a lot, you see them a lot. They are mentioned on analyst reports, in the FT, on Bloomberg terminals, and websites such as Digital Look. And of course, MoneyWeek uses PE ratios all the time. But what do they actually mean? And how do people use them? Well, the good news is, although we're going to run through a calculation in a moment, you'll probably never have to. Normally they're done for you, and you see the end result. But to really understand what a PE ratio is all about, you need to see a little bit of what's under the bonnet. So, why would we use a PE ratio? In short, as an investor, we want cheap shares. We don't want rubbish, we want quality companies, but we want them at a decent price. And there has to be a way to find a cheap company. And there is. The PE ratio is one way of doing it. It's not the only way, but it's a popular way. So the objective is to use a PE ratio to determine whether a company is cheap or expensive. So let's take a look at a calculation. What is the P and the E? In short, the P is a company's share price. So we could start with the price per share for a company such as a food retailer. So we could start with Tesco. And at the moment, the Tesco share price is £4.20. Now the question we're asking is, do I want to buy Tesco at £4.20? Is that too much? Is that a bargain? I don't know. Price earnings ratios are one way of finding out. So let's compare the share price to something. And what the price earnings ratio compares it to is what's called earnings per share. That's an accounting number. It's something you can pick up from a set of accounts, and it represents 1 year, normally the last 12 months. Earnings, that's profits, per share. So, I happen to know that the Tesco, at the moment, that's around 30p. So I've got today's share price, that'll change tomorrow or next week, compared to 1 year's earnings on a per share basis, because this is one share, so this needs to be expressed per share as well. So we're not comparing apples with pears, if you like. And that gives a number. The result, if you like, is around 14, or 14 times. It's just a number, or what analysts sometimes call a multiple. So another word is the PE multiple. So what we're saying is there is a number called the PE ratio that looks at the share price in earnings terms. In other words, if you pay £4.20 to buy Tesco right now, you are paying 14 times 1 year's earnings to get it. And I suppose the question is, does that mean you should buy it or not? Difficult question to answer. You could look at just Tesco by itself. You could say, well, what does this tell me? This tells me that if I buy at £4.20 and earnings don't change, it'll take 14 years just to get my £4.20 back, let alone make anything. Would I wait 14 years? Probably not. Most investors wait no more than 3 or 5. So how can I tell if Tesco's a bargain? Well, the answer is compare it to something. So if we take away the calculation, what we could do is take that number 14 and look around for something to compare it to. So let's take the Tesco price earnings ratio and hunt around for something to compare it to. So we've got Tesco trading on a PE ratio of 14. An obvious thing would be to ask, is that cheap or expensive in relation to, say, Sainsbury's, one of their biggest competitors? So let's imagine we look up the Sainsbury's PE ratio and we find that it's 13. So now we know that Tesco trades on a PE of 14 and Sainsbury's is a little bit cheaper on 13. But still, I'm torn between the two. So it's going to take me 13 years to get my money back if I invest with Sainsbury's and 14 years with Tesco. So maybe I need to do a bit more work before I decide whether I buy Tesco or whether I buy either. Maybe what I could do is look at the sector. So I could look up in the FT or on Bloomberg I could look up the food retailing sector, need to get the right one, and let's say that that's trading on a PE multiple of 16. So suddenly I'm thinking, well, these two supermarkets, big brand names, look relatively cheap compared to the sector, and Sainsbury's is a little bit cheaper than Tesco. So now I might want to ask the question, why? Is there a reason why Sainsbury's and Tesco are a little bit cheaper than the sector average? What's happening to suggest that these two should trade on lower multiples? It could be that they're a bargain, that's what I'm looking for, but I need to be careful because maybe there's something going on. Maybe senior directors are thinking about leaving these two supermarkets. Perhaps there's some kind of price war going on in their part of the market. Perhaps one of them is struggling to expand overseas. Tesco, for example, has hit problems in America. So I need to look for some more information, and that tells you one of the limitations about PE ratios. By themselves, even when you've got something to compare them to, they can be dangerous. You need to understand why a company is cheap. Is it a bargain, or is there a problem factored into the share price? I could go further though. These are listed FTSE 100 companies. So maybe what I want to do is say, well, okay, they look cheap in relation to the sector, but am I even looking in the right part of the market for cheap shares? So perhaps what I should do is just take a look at the wider market. So I could look up the FTSE 100. These companies are both members of that club, the top 100 companies in the UK, and yeah, these are looking cheap relative to the rest of the market. So the key with ratios, all ratios, not just the PE multiple, is to hunt around for something to compare them to. By themselves, they're a little bit dangerous. Once you've got a comparison, then you can start to ask the question, do I think one of these companies is cheap, and which one do I want to buy? How high can PE ratios go? Is 17 high? Is 14 high? Well, supposing I've designed a online clothing retailer called boo.com. Its model allows you to size yourself up on the internet, look at yourself as a kind of dressed mannequin, and then order the clothes you see. And let's say boo.com, a technology company, has a PE ratio of 100. What does that mean? Does anyone wait 100 years as a shareholder just to get their money back? No. You might wait 10, you might wait 14 in the Tesco example, you might wait 20, probably you don't, and you certainly don't wait 100. So what's going on? Is this a nonsense figure? No, it isn't, because if we think about what that multiple represented, it was the share price as a multiple, 100 times earnings per share. So in essence, that does tell you something. It says if you're prepared to pay 100 times 1 year's earnings per share to buy a company like this, a technology company, you must be expecting something pretty spectacular to happen here. You must be expecting very fast earnings growth. Otherwise, why on earth would you pay 100 times 1 year's earnings for the share? You're not going to wait 100 years, you're not even going to wait 50 years, and the only way you're not going to be waiting that length of time is if earnings rocket. And that's the point. A lot of high technology companies are expected to produce big earnings very quickly. They're expected to expand fast, and they're expected to deliver an increase in earnings fast. So people will sometimes pay what seem like crazy multiples, but frankly, it's a gamble. So as a rule of thumb, the lower the PE ratio, the better your chances of making a return. And that's why, as a rule of thumb, if there's no reason why a PE ratio is low, there aren't problems at the company, you'd always prefer a low PE multiple to a crazy one like that. And a good starting point is always the UK market.